The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You are listening to Money in the Morning with Mitch Goldberg on LI News Radio, 103.9 FM. Thank you so much for joining us. A bunch of things to go over today. We start the show today with a look at the pre-markets. Dow looking to be off a bit, down 108 points, building on yesterday's mild retreat. S&P futures down about 14, NASDAQ futures down about 35 points. Mind you, these are all fractions of a percent, nothing major. Oil, West Texas Intermediate, is off about 75 cents the barrel. The 10-year Treasury, that just continues to persistently rise. It's at 3.77%. And yesterday, for the first time in over 15 years, we saw a Treasury security with a 5% plus yield. The 6-month T-bill is now yielding over 5%. This is a hurdle. So if you buy an investment, if you invest in a stock, it's because you expect it to earn a return above and beyond 5%, and you're taking risk on it. So you really want a much higher return than 5%. So that's why higher interest rates become a hurdle for stocks. It's one big reason. The other reason is when we value future earnings, the higher the interest rates are, lower today's interest rates. A lot of nuance factors going on. There's sentiment. There's all kinds. There's money flows. There are lots of things that determine stock prices. And this show is not about. We're not about predicting stock prices, but we are here to help you make better decisions about your investing, about your personal finance, so you can become the best possible version of your financial self. So we are building on yesterday's mild retreat in the Dow and the S&P. NASDAQ yesterday, though, was up over 0.5%. The VIX was off just a drop, but the VIX remains around 20, a little under 20. It tells you that the level of worry is not so great with professional money managers. And it makes sense because if you look at the volatility this year, it's been a pretty mild year in terms of volatility. We haven't had huge swings this year. We've just been trying to meander our way around. Okay. This just out, retail sales figures just released by the Commerce Department were a blowout number to the upside, up 3% versus 1.9%. When you exclude autos, it still was a blowout number. So this just builds on to the strong employment report. Look, people have jobs, so they're spending money. People have jobs, they're not getting foreclosed on their houses. So housing inventory is just not going up. That's why I'm optimistic that housing is not facing some existential crisis or a crash like some other people are predicting. And I do like to avoid using hyperbole. I think it's just getting viewers and clickbait. So we avoid hyperbole here. We just stick to the facts. And mortgage demand did drop because interest rates are up a little bit. Mortgage demand, even for new homes, is off a little bit, which is right ahead of the key selling season, which starts in 14 days. We call it March 1st. So that's what's going on to get your day started. It's a special day today because I have my partner with me, Bobby Bird, CFP.
Good morning, Mitch.
Good morning. How are you?
Good to have you. Good to be here. Doing very well. Thank you.
Okay, so great to have you. Bobby and I work together with our clients here at Client First Strategy. And if you hear anything you like and you want to take this conversation offline into a personal detail call, just check us out at Client First Strategy. All our contact information is there. So, Bobby, we were just talking about a couple of things. We were talking about the yield curve.
Yeah. So the yield curve, right, continues to invert. So what that means is that the short end of the yield curve is trading at a higher yield than the longer end of the yield curve, right? So the 3-month, the 6-month T-bill yield is trading as of now, well, as well as the 2-year, the 2s10 spread, which you hear a lot on the news out there, 90 basis points inverted, right? That means that the 2-year Treasury yield is 90 basis points higher than the 10-year. So that tells us what? That tells us that the Fed is still on the trajectory, probably of rising and hiking rates in the short term, because they're trying to fight off this persistent inflation. So that's still is big news out there. And to your point, we've got jobs data that was very, very strong for January. We have retail sales, which continue to go up. So the blowout to the economy that everyone was expecting. And to be honest, I was at one point at the end of last year thinking that we were going into a recession at the beginning of this year. Now, it may still happen, and the Fed probably still has a little bit of work to do, but it's something that we're, continuing to keep track of.
Well, here's a thought. We had 2 quarters in a row of negative GDP last year. And maybe, just maybe, we had our recession already. And maybe we're already on the road to recovery. Maybe the stock market, investors, market participants are actually happy about the Fed raising rates because we're more concerned about getting inflation under control than near-term economic volatility. And just, I hear what you're saying. Like the base case scenario is either soft landing or hard landing. Hard landing means we slow down the economy so much, the Fed slows down the economy so much with interest rate hikes that we go into recession. The soft landing is we slow the economy down enough to bring inflation down without pushing the economy into a recession.
Correct. Right.
Now, the third scenario, which is growing in popularity, Ed Yardeni, one of the top strategists I follow,
right,
says that, and I've been saying this in the show now for a couple of weeks, no landing.
No landing. Yes. Right. That's exactly
slowing
right.
Maybe, but statistically speaking, now this does not mean that someone's not having a financial hardship or job loss on their own as an individual. I'm talking broad picture. We're not slowing down. The economy appears to be accelerating. And the difference between now and other times that we've had inflation, okay, is that in this, people talk about the 70s and early 80s inflation. We have low unemployment today. We don't have high unemployment today. And ultimately, it's employment that determines foreclosures, slowdown of retail sales, bankruptcies, all the typical personal financial problems that are associated with a recession have to do with employment figures.
Right.
Which, anecdotally, you go out to a restaurant today on a Friday or Saturday night, everything is packed.
Yeah.
So
you know what it is too? If I can just interject here, since the pandemic, right? I think the game has completely changed with respect to the employment picture, right? We're still an economy that pretty much is gainfully employed, but we're also an economy where, almost 2/3, maybe even more of the workforce is working in a hybrid role. Think about that. Think about what that does to, the average employee and their family. If they're not spending a bunch of money commuting to work as often as they once were, right? They're not spending a bunch of money eating out at restaurants. I worked in the city, as did you, right?
Yeah, we're not spending money on dry cleaning.
So the train rides, right? The dry cleaning, the going to grab, a sandwich and a coffee at the local place. All that stuff is starting to
That's a help. So it's kind of a fight against inflation.
Right.
All right, folks, stick around. We're going to talk a little bit more about the economy and the market, but we're going to get into some personal finance stuff. The stuff that you really need to know, the kind of thing that I say, what do you do with all this information? We're going to give it to you. You're listening to 103.9 FM LI News Radio. This is Money in the Morning with Mitch Goldberg and Bobby Bird. Check us out at Client First Strategy and moneyinthemorning.info. We will be right back after these very brief messages, so please stick around. Okay, we're back. I know we like to listen to the really cool music, but I really want to squeeze in every second I can in the show because the time we have together just goes by so freaking fast. Happy Hump Day, everybody. You're listening to Bobby and Mitch, Money in the Morning, and we have just such great things to cover today. Bobby, you and I were talking about the market, and my contention is that we have to be open-minded to the idea that we might be in for a really long, sustained bull market, almost like the 1990s, from let's say 95 to 2000. And in that era, unemployment was low. Inflation was not as high as it is now, but it was a lot higher than it was 2 or 3 years ago.
Right.
I think we need to be more open-minded. I think there's too much pessimism. I like this. What I said to someone the other day, I said, everybody talked about how this quarter was going to mark a quarter of weak earnings, a bad quarter, corporate earnings, is going to be terrible. Well, earnings were out. 69% of companies exceeded expectations. The usual number is 79%. But overall, S&P 500 companies, by the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So, earnings were down for the quarter, for the fourth, that was just announced, the fourth quarter, a little over 2%.
Right.
I mean, is that it? Is that all you got for us? I mean, that's what you're trying to scare me with, is a little over 2%?
A little over 2%.
No.
Yeah.
So, is inflation this high the new normal? It could moderate. I mean, we could see it come down to 3-4%. I don't think prices go back to where they were pre-pandemic. When you hear about inflation rates, it's the rate of inflation now, of growth. It doesn't mean, inflation is only 2%. It doesn't mean we go back to previous prices.
Right.
Inflation just means we went up 2% from where we are now. So it's permanently higher prices, sparked by a couple of things. Number one is the reduction in globalization, global supply chains, as we move more production here, reshoring or onshoring production.
Right. Yep. That's a big part of it.
That does raise costs, but it also raises our security.
Correct.
So there's a huge benefit to that. Plus, we have more jobs, and I believe that the CHIPS Act, the Inflation Reduction Act, these are huge programs. The Infrastructure Act, the amount of spending on projects is going to keep employment high, unemployment low.
Yeah.
So maybe we could live with inflation, take that into consideration, and say that we will have better companies going forward, because when you have interest rates at zero, you get bubbles in speculative areas, from crypto to pot stocks to meme stocks, that sort of thing. What's your take?
Yeah. So I think kind of in the long run, right, if you take a look at the demographics of the country, right, I mean, almost all of the baby boomers are near or at their retirement age, right, already by now. My dad is 75. He's long been retired.
He's long been a baby boomer.
He's long been a baby boomer, and he's long been retired. So you have, a country and a demographic where, the employment is going to have to be kind of held up by younger generations. And maybe there aren't as many of us as there were back during the baby boom generation. Gen X, that's my generation, right? I mean, I'm 46. I'll be 47 this year.
People
right?
talking about my generation, talking about my generation.
So there's always these, these evolutions with respect to.
I get old. Sorry, I just couldn't help it. My ADD is kicking in so bad right now.
I may burst into song at some point down the road. But so you've got technology companies that are doing like these mild setbacks and layoffs of people, but
they haven't spread to the general economy yet, though.
Right. No, they haven't.
And if you look at Indeed.com, of the top 25 job openings, I think like 21 out of the 25 are all for technology. So they're getting absorbed by smaller tech companies that need manpower.
And the gig economy is absolutely huge, right? With respect to Instacart, with respect to Drizzly, all these things that we take for granted. Someone somewhere is delivering your stuff to you, right?
We're driving you, Uber, Lyft.
I think there are more and more people who are working 1, 2, 3 jobs. So that's where I think we see the strength in the economy. That's where we see the resiliency in prices. And I think the Fed is at a position where they kind of have to come to terms with, we can't play by the old rules, right? We can't play just by the Phillips curve, because the Phillips curve isn't, may not apply in this day and age.
Right. The Phillips curve says that there's a natural level and a healthy level of unemployment, which is 5%. And that gives you some extra slack. So when you need some more labor, you could take from that 5%. When you don't need some labor, you could add a little bit to it, but that's like a little extra surplus of labor, which is considered healthy. But with so many people out of the workforce and so many people retired and an aging demographic as a country, as a society, that in that regard, the Phillips curve doesn't really help that much anymore.
Sure. Yeah. And like all those people doing the gig work, right? That's not tracked by ADP. That's not tracked by, the payroll companies. So there's probably a bit more strength and resiliency to the economy than I think we give credit to, which is, is why the Fed is still persistently, trying to, tamp down inflation.
Right. The Fed could either tamp down demand or raise supply. It can't do anything about supply. It doesn't manufacture anything. It does print something. It could print money. And it could destroy money.
Right.
It could do one or the other. Right now, it's in the destroying of money. Over $500 billion is off the Federal Reserve's balance sheet. They've raised rates the fastest and the most in this amount of time ever in history.
Yeah.
And yet the economy is piping, moving right along.
Right. So the game plan that, I think we've been telling our clients is this, right? You have a situation where we have high yields on the short end of the curve, right? That's cash alternatives. So for those that have a heavy cash position, take advantage of that, right? Don't just sit kind of idle and be complacent with cash, but put your cash to work. Put your cash into treasury bills that you've just been pounding the table on for the last 6 months. These high rates on the short end are going to last forever. So take advantage of it. B, stocks generally always tend to bottom before, the end of an economic slowdown, right? So always have some exposure to stocks that you're comfortable with. That's in the context of someone's tolerance for risk.
Right. So
and don't wait for this magical pullback where the stock market's going to drop and you say, I'm going in. Right?
It never happens.
Because it never happens.
It's called the Sunday punch. Investor, if your investing strategy is the Sunday punch, the market goes down a lot, you'll say, well, I'm going to wait for the market to go down even more before I pull the trigger. And then the market goes down more, and you say, well, now it's going down even more. I'm going to wait. Then the market goes up, and you say, no, I could have bought when it was lower, so I'm going to wait for it to go lower. Then it goes lower, and now you say, well, it's going lower. Then it goes up, and you say, wait a minute, I could have bought lower. Now it's going up. It just becomes endless procrastination when we know that long-term investing is a very good way to go for 99.9% of us. And just focus on your life, your career, your family, the things that are important, and focus on the things you can control, like putting money into your retirement plan, rebalancing, understanding your risk tolerance. We'll talk more about that. So the music is here already, and the show goes by too fast. What do you think, folks? Maybe we should make this into an hour show. All right, we'll have to discuss that. Okay. Hey, you're listening to Money in the Morning with Mitch Goldberg and my special guest and partner, Bobby Bird. You can check us out at clientfirststrategy.com. You're listening to 103.9 FM at iNews Radio. We'll see you tomorrow. Thank you,
Mitch. Have a great day, Long Island.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions